Hello students, in present video I am going to explain about third problem from partnership accounts topic. I am taking this question from Telangana State Telugu Academy Inter Second Year Accountancy Textbook. But this video is useful to all commerce students who want to know about this topic. Previous videos links are available in the description box. Let us see the question first. A and B are partners sharing profits and losses in the ratio of 3:2 respectively. So 3 number belongs to A, 2 number belongs to B. So A's share is 3/5. How 5 comes? 3 plus 2. B's share is 2/5. A contributed 2 lakh rupees and B contributed 1,50,000 rupees towards their capital at the beginning of the year. So opening capitals are given in the question. When they started business, they have to bring the capital now. A brought 2 lakh rupees capital, B brought 1,50,000 rupees capital. Their drawings during the year amounted to 10,000 rupees and 12,000 rupees respectively. So when partner is running a business, then for their personal expenses from this business only they withdraw money now. So A withdrew 10,000 rupees, B withdrew 12,000 rupees. So these two are drawings. Continuation. Mr. A is entitled to a salary of 8,000 rupees and B to be given a commission of 10,000 rupees. Interest on capital to be provided at the rate of 10% per annum. Interest on drawings amounted to 500 rupees for A and 600 rupees for B. Net profit before above adjustments amounted to 62,000 rupees. This is the question. Finally, what he is asking us to prepare? Prepare profit and loss appropriation account and a partner's capital accounts under fluctuating capital method. This is the question. Let us see the solution for this. First of all, recollect the final accounts of sole proprietorship business. We used to prepare trading account, profit and loss account and a balance sheet. No? Similarly, in final accounts of partnership business, we have to prepare these 5. Trading account, P&L account, profit and loss appropriation account, partners capital accounts, finally balance sheet. To prepare partners capital accounts, 2 methods are there. Fixed capital method, fluctuating capital method. So what are new? Profit and loss appropriation account and a partner's capital accounts. Trading account, P&L account and balance sheet. In final accounts of sole proprietorship, already you practiced. So these are 2 new points, profit and loss appropriation account and a partner's capital accounts. These 2 he is asking in this problem. First, profit and loss appropriation account means what? See, first 2 accounts are nominal accounts. No? Nominal account rule, debit all expenses and losses, credit all incomes and gains. These rules we used to follow when we are preparing final accounts of sole proprietorship. As per that, direct expenses and losses in trading account on debit side we used to show, direct incomes on credit side, direct expenses, losses, example, wages, purchases, carriage, octroi, etc. Direct income example, sales. Similarly, in profit and loss account, debit side we used to write indirect expenses and losses. For example, salaries, rent, postage, stationery, etc. Credit side we used to write indirect incomes. For example, interest received, commission received, discount received, etc. Now come to third point. Profit and loss appropriation account. This account is also a nominal account. So nominal account rule we have to follow. That is, debit all expenses and losses, credit all incomes and gains. You may get one doubt. Expenses are of 2 types, direct and indirect. Incomes are also direct and indirect. All these amounts already we have shown in first 2 accounts now. Then in this account, which expenses we should show, which incomes we should show, doubt comes now. Debit side, partners related expenses we should show. For example, Firm paid salary to employee. To the firm, this is an expenditure. And this expenditure is related to employee. No? Suppose A is active partner. Firm paid salary to A. So to the firm, this is also an expenditure. But expenditure is paid to A, no, partner, no, not to the employee, no. Thus, partners related expenses, debit side we should show. Partners related incomes, credit side. And once you recollect final accounts of sole proprietorship, in trading account, if gross profit comes, we used to take that in P&L account. By taking gross profit only, we have to start P&L account. No? Similarly, in P&L account, if net profit comes, by taking that amount only, we should prepare profit and loss appropriation account. And in question, net profit is available. See, net profit before above adjustments amounted to 62,000 rupees. As directly net profit is given, we need not to prepare trading account, profit and loss account in this problem. That is why he is asking from profit and loss appropriation account. Net profit, we said we should show in this account. In P&L account, debit side net profit comes. Credit side we should show. By net profit, 62,000 rupees. See the remaining points from the starting. A and B are partners sharing profits and losses in the ratio of 3:2 respectively. A contributed 2 lakh rupees and B contributed 1,50,000 rupees towards their capitals at the beginning of the year. These two are capital amounts. No? Capitals are not incomes, not expenses. Therefore, we should not show capital amounts in P&L appropriation account. Ignore. Next, their drawings during the year amounted to 10,000, 12,000 respectively. Drawings also same. It is not an expenditure, not an income. So don't show in P&L appropriation account. Next, Mr. A is entitled to a salary of 8,000 rupees. So to A, firm has to give salary 8,000. To the firm, this is an expenditure. No? Expenditure, debit side we should show. Partners related expenditure. Therefore, in P&L appropriation account, debit side we should show. So write down. To A's salary 8,000 rupees. Continuation. And Mr. B to be given a commission of 10,000. This is also partners related expenditure, debit side only. To B's commission 10,000 rupees. Next, interest on capital to be provided at the rate of 10% per annum. Capital means what? Partner brought the money into the firm. In accounts, we follow business entity concept now. What that concept says? Firm is separate, owner is separate. When owner is bringing capital into the firm, we should assume that firm is taking loan from owner. So who should pay interest to whom? Firm is taking the loan now. Therefore, firm should pay interest to the partner. In firm's books only we are preparing P&L appropriation account. Think from firm's point of view. Firm has to pay the interest. Means to the firm, this is an expenditure no? And this interest we are paying to partner. Means partner related expenditure no? So profit and loss appropriation account, debit side it appears. Interest on capital. First A. 10% on A's capital. A contributed 2 lakh rupees capital no? On 2 lakh rupees, 10%. 20,000 rupees in inner column. Next B. B invested 1,50,000 rupees capital. On the 10% interest firm has to pay. Amount is 15,000 rupees. Add these two amounts, total in outer column. 35,000 rupees. Continuation. Interest on drawings amounted to 500 for A and 600 for B. Drawings means from the firm, partner withdrew some amount for personal use. So partners are running business. They too have families, no? They have to meet family personal expenses, no? From where they get the money? From business only they should take. So A withdrew 10,000 rupees, B withdrew 12,000 rupees. These two are drawings amounts. And on these drawings, who should pay interest to whom? As per business entity concept, owners are outsiders, no? One outsider is taking money for his personal use. Our assumption is firm is giving loan to them. So who should pay interest to whom? Partner should pay interest to the firm. In firm's books, we are preparing this account. To the firm, this interest is an income, no? So in P&L appropriation account, credit side we should write. By interest on drawings. A's interest is 500 rupees. And B, 600 rupees. Total in outer column, 1100 rupees. So everything is completed now. Finally, we have to find out the totals of two sides. Credit total is more than debit total. So in draft notes, credit total 63,100 minus debit total 53,000 rupees. Difference is 10,100 rupees. Credit side we wrote incomes, debit side expenses. Income is more than expenditure. Therefore, difference is profit. This profit to partners' capital accounts we have to transfer. Recollect inter first year, sole proprietorship business final accounts. In P&L account when profit comes, net profit, in balance sheet to capital we used to add. Because sole proprietorship, no, only one owner, no, one capital, no. Therefore, no need to separately prepare capital account. Directly in balance sheet only we used to add to capital. But this is partnership business. Here, two partners are there. So instead of adding the profits to capitals in balance sheet, we have to show the capital account separately. Here we have to do all these adjustments. So this profit to partners' capital accounts we should transfer. Which side total is less? Debit side. Therefore, debit side you have to show this transfer. 2. A capital. Profit is 10,100. In this, A's profit sharing ratio is 3/5 no? Into 3/5. To B. To B capital. Profit amount 10,100 into 2/5. So 5 ones are 5 twos are 0 again to 0. 2020. 2020 into 3. 6,060. Similarly, 2020 into 2. 4,040. In total profit 10,100. A's share is 6,060 rupees. B's share is 4,040 rupees. These two amounts we should transfer to their capital accounts. And two sides write down the highest total. Credit total 63,100. Credit side also same. With this, profit and loss appropriation account is completed. Next come to capital accounts of two partners. Capital accounts under fluctuating capital method. Format is particulars AB, particulars AB. Debit side, credit side. To prepare capital accounts, two methods are there now. Fixed capital method, fluctuating capital method. When firm follows fixed capital method to prepare capital accounts, suppose partners are sharing profits and losses in the ratio of their capitals. In this case, they follow fixed capital method to prepare capital accounts. Because every year opening and closing capital should be same. Suppose they are not following capital ratio, other ratio they are following. In this case, they may prepare capital accounts under fluctuative capital method. Suppose in question, he has not given the information properly. Under which method we have to prepare capital accounts? In this case, our assumption is fluctuative capital method we should apply. And in present problem, clearly stating now, prepare profit and loss appropriation account and partners capital accounts under fluctuating capital method. So no confusion. We have to prepare capital accounts under fluctuating capital method. And to prepare capital accounts, rule is capital account is a personal account, representative personal account. Because in the place of owner's name, we write a capital word. Capital word represents a person's name. It is a representative personal account. So personal account rule we should apply while preparing capital account. What is personal account rule? Debit the receiver, credit the giver. Means from the firm, if partner is receiving any benefit, debit side we should show. To the firm, if partner is giving any benefit, credit side we should show. Same point in another manner also I will tell. Debit the receiver. From the firm, partner received. Suppose he is retiring, then whatever he received, he should return. So, at the time of retirement, the amounts which partner should return to the firm, debit side we should write. Remember like this, it will become easy to you. Similarly, credit the giver means if partner has given any benefit to the firm, credit side we should write. Same point in another manner I will explain. Partner has given to the firm. Suppose partner is retiring, then firm should return that amount to partner. No? At the time of retirement, the amounts which firm should return to partner, credit side we should write. So be clear with this point, with this hint. At the time of retirement, partner should return to the firm. All those amounts debit side. At the time of retirement, firm should return the amount to partner. All those amounts credit side. When I explain the points, this point will be more clear to you. See, A and B are partners sharing profits and losses in the ratio of 3:2 respectively. A contributed 2 lakh and B contributed 1,50,000 towards their capitals at the beginning of the year. These two are opening capital balances, no? So capital is a liability. Liability shows a credit balance. Therefore, these two opening balances, credit side we should write. For opening balances, what to write? By balance brought down. A brought 2 lakh rupees, B brought 1,50,000 rupees. Same point, with the help of this hint also we can analyze. A brought 2 lakh rupees into the firm. A is a giver, therefore credit side. Suppose A retired, then firm should return this 2 lakh rupees to A, no? At the time of retirement, firm has to pay these two amounts to partners, no? That is why they are appearing on credit side. Like that also you can remember. See the continuation of the question. Their drawings during the year amounted to 10,000, 12,000 respectively. A withdrew 10,000, B withdrew 12,000. If they retire, whatever they have taken from the firm, again they should return. No? So, at the time of retirement, drawings amounts, who should pay to whom? Partner should pay to the firm. Therefore, debit side we should write them. Two drawings. A's drawings amount is 10,000 rupees. B's drawings amount 12,000 rupees. Next, continuation. Mr. A is entitled to a salary of 8,000 rupees. So, at the time of retirement, firm should pay salary to A. Firm should pay to A. So, which side? Credit side. By salary. To A, firm has to pay now. Therefore, amount in A's column, not in B's column. For B, nil. Continuation. And Mr. B to be given a commission of 10,000. Firm has to pay 10,000 rupees commission to B. Firm has to pay to B, partner. So, credit side only, na? By commission in B's column, not in A's column. For B, 1,50,000. Continuation. And Mr. B to be given a commission of 10,000. Firm has to pay 10,000 rupees commission to B. Firm has to pay to B, partner. So credit side only, na? By commission in B's column, not in A's column. For B, 10,000 rupees. Continuation. Interest on capital to be provided at the rate of 10% per annum. Interest on capital, who should pay to whom? In P&L appropriation account, clearly I told. Partner has given capital to us. Means partner has given loan to us. So, we have to pay interest to them. Firm has to pay interest to partner. So, firm has to pay to the partner. Means we said credit side. So remember, interest on capital, credit side we should write. In appropriation account we have calculated to A, interest is 20,000 rupees. B, interest amount is 15,000 rupees. Continuation. Interest on drawings amounted to 500 for A, 600 for B. Interest on drawings, who should pay to whom? Here I have explained now. So partner should pay to the firm, because drawings partner has taken loan from the firm. Now partner should pay drawing interest to us, no? So interest on drawings partner should pay to the firm, means debit side. To interest on drawings. A, 500 rupees. B, 600 rupees. Continuation. Net profit before above adjustments amounted to 62,000. Net profit we have taken in appropriation account credit side now. Again we should not take here, ignore. And don't forget one point. That is P&L appropriation account answer. So these two amounts, partners profits no. When they retire, firm should pay to them no. Means these two amounts we said we should show credit side. And from where you are taking them? From P&L appropriation account. Therefore that account name you have to write here. By profit and loss appropriation account. 6,060 for A, 4,040 for B. Everything is completed. Finally we have to balance capital accounts. Find out the totals of two sides. For partner A, credit total is more than debit total. So the balancing figure debit side it appears, because debit total is less. 2,23,560. Total, highest total two sets. 2,34,060 rupees. Credit side also same. For B partner also same now. Credit total is more than debit total. So the balancing figure, debit side we should write. 1,66,440. Two sides, highest total. 1,79,040. Credit side also same. For these two answers, here you have to write to balance carried down. Which balance this is? Credit total is more than debit total. No? So this balance is known as credit balance. So remember, under fluctuative capital method, capital accounts of the partners show credit balance. And why this method is known as fluctuative capital method? Opening capital amounts are 2 lakh rupees, 1,50,000 rupees. And all adjustments we have shown in this account only now. Adjustments we have done to opening capitals now. Therefore, closing capital amounts are not the same. So fluctuated, changed. That is why this method is known as fluctuative capital method. So this is all about third problem from partnership accounts topic. Hope this video is helpful to you. Thank you.